Hello and welcome. I am Juan Carlos Artigas, Global Head of Research for the World Gold Council, and I'm joined today by Joyce Chang, Chair of Global Research for JP Morgan. Joyce is a well-recognized industry leader in finance and is currently focused on longer-term strategic topics relevant for investors, including structural shifts in asset allocation strategies, as well as ESG. Joyce, thank you so much for joining us.
Great to be with you, Juan Carlos.
Excellent. So, let's start. Look, monetary policy. That is a topic that is top of mind for many investors, in particular, tapering and interest rate normalization by the Fed. So, starting with that, what is your expectation on this?
Well, at the last meeting, the FOMC has signaled very strongly that it will go ahead with tapering at the next meeting in November. And so no surprises there. This is very much in line with what the market had expected. Now, they are going to finish, I think, a little bit earlier than expected. They've indicated that they will finishing this tapering cycle by the middle of 2022. But I think more importantly, Chairman Powell stressed that the conditions for a liftoff are more stringent than those for tapering. So we still have in our official view that the Fed does not start hiking until 2023. But I have to say there is a risk that this is pushed into 2022. But they've made the liftoff very distinct from the tapering process. We've seen Treasury yields move up a bit, since then. After really coming down quite sharply from the beginning of the year. And we still think that, you're still quite a ways away from fair value, probably 25, 30 basis points still below fair value for U.S. Treasury 10-year yields. So we're forecasting the 10-year yield at 1.75% at the end of the year, and the 30-year at 2.4%. So I still think we're in an environment where there's still, a considerable move in rates between now and year end.
Yeah, it makes sense, and it's interesting to see different perspectives coming from the market. But generally, I think that people are indeed waiting a little bit more of a slow approach to this. But taking a step back and thinking about a global perspective, something that is quite topical and has been more and more apparent are the unintended consequences of the fiscal and monetary policies put in place to alleviate the impact of COVID-19. Potential higher inflation is one, but I know that you have also been drawing attention to debt sustainability. So could you expand on these and how investors should prepare to mitigate these risks?
Well, let's just start with inflation because we are seeing the highest core inflation levels in 25 years. And we think that global core inflation is going to stay elevated here at a 3% annualized rate for the remainder of the year. Now, the U.S., especially in the U.S., we've seen much higher inflation. Here, we see core inflation will likely hold around 4 to 4.5% for the remainder of the year. And the focus has been on the supply chain bottlenecks, which have contributed to this year's inflation shock, which everybody thought would be temporary, but they have persisted longer than expected because of the Delta wave.
Thank you, Joyce. These two topics are very important indeed, and for us are also an area of consideration. In particular, if we think about gold specifically, higher interest rates tend to create headwinds for gold, and that's a concern for many investors. At the same time, though, both potential higher inflation on the one hand, but also your comments about debt servicing and debt sustainability can create risks overall for investors, whether it is through impact on currencies or just more risk and volatility, which in turn might make gold relevant for investors again as means to hedge. And for that perspective, we've developed a tool called Quorum, which is a valuation tool that helps investors understand and analyze different macroeconomic scenarios depending on their own views and how gold in particular may react to these conditions. But keeping with the global theme, another important and interesting perspective here is that we saw the beginning of a shift towards deglobalization prior to the pandemic. But COVID seems to have exacerbated it as countries dealt with travel restrictions and supply chain disruptions. So do you expect this trend to continue, and how are investors adapting to this dynamic?
No, thanks so much for that question. But just a follow on just what you're looking at as far as hedging inflation risk, and we do think that agriculture, livestock, industrial metals, and energy future returns are all positively correlated with U.S. inflation over long investment horizons, and that investors will have to think more about hedging this inflation risk. Whether it's agriculture and livestock, small amounts of energy futures, that those might all be ways in which inflation is hedged. But turning to the whole topic of deglobalization, I think all eyes are focused on the US-China relationship, which has really evolved into a full-fledged strategic and national security competition. And there was a lot of debate when Biden came to office on whether there would be a reset. And we've actually seen a reset by both sides, the US and China, that seems to be taking a much harder line. It's moved away from trade. It's focused on tech and cyber security. There's a much more explicit discussion about shared values and democracies working together through multilateral coordination with the European and Asian democracies. And there is much more of a focus on self-sufficiency, developing secure supply chains and not having the reliance on both the US side and the China side. And I think that, we think this is something that is a shift that's for the longer term. When you look at China's common prosperity goals, these are longer term goals to strengthen the social protection, reduce inequality. And I think that, we're still at a fairly early starting point for common prosperity, as these goals are ones that the government has outlined, and the authorities in China have outlined as wanting to sort of achieve common prosperity by 2049 and have these goals sort of, have measurable progress by 2035. So I think this is a longer term shift for US-China relations that has implications for how we look at the supply chain and how some of these dynamics could play out. Now, I do think that just a lot of the research that we've done and that others have done, question whether this sort of approach of decoupling is actually going to work. There's a lot of research that's been put out, including by the International Monetary Fund, that really points to that a tech war could cost more than the trade war did. So a longer term shift that is really, I think, a big paradigm shift in the U.S.-China relation that will play out for years to come.
Thank you, and that's extremely interesting, and I agree. I think that deglobalization is a topic that has captured the imagination, especially in recent months, and for investors. And look, all these topics that we've been discussing so far have impacted asset allocation strategy. We recently worked with Coalition Greenwich on a global allocation study. Then the findings reveal that investors are increasingly moving towards alternative assets such as private markets, commodities, gold, etc. So what are you seeing in terms of redefining diversification in this new environment?
Well, one question we really are getting is this the time in such a low yield environment away from the traditional 60-40 formula? And 60-40 for the last 4 decades really could reliably deliver about a 10% return, but with still more than 90% of developed market central banks with 1%, we're looking at returns in the bond market coming down and also returns in the equity market coming down. So we're looking at whether 60-40 really means a 3.5% to 4% return going forward, which means there has to be a way in which investors are looking for alternative assets to meet their return targets. So we've written extensively about this, and what we are recommending is more of an allocation to what we're calling hybrids. Basically instruments that are fixed income but offering more equity type returns. So what do we mean by this? High yield bonds and loans, emerging markets, CLOs, CMBS convertibles, mortgage REITs, preferreds. And what we've really advocated is that for investors who are really focused on the longer term risk and they want a 5% or higher return, they are going to have to maybe do something that's more like a 20-40-40 of bonds, hybrids, and equities. So I do think that one of the outcomes from this pandemic could be a real change in the way that we look at asset allocation. We are also seeing that for commodities, most investors had really been under allocated in commodities. And so it's not just the inflation hedging, it is whether an allocation to commodities is something that should be added, but also some of these higher yielding fixed income instruments as well.
Yeah, we agree. And what is interesting as well is that that shift in allocation, and you put a good example on the 20-40-40, also changes the risk profile, right? Of what investors have been traditionally used to in terms of where the risks are coming from. Maybe credit risk or liquidity risk become more prevalent in this environment, or just simply the expected volatility that they need to cope with is different to what it was before, given the smaller potential share of fixed income assets within a portfolio. And that's something that we have also been hearing from our investors. And interestingly enough, that's also one of the reasons we've seen an increase in adoption of gold as a overall strategic component in portfolios. As you were saying, perhaps it's not just about the inflation piece; it's more generally diversification. So that definitely resonates with us.